Welcome to the end of week macro wrap up. I've got some new software and a new microphone, so hopefully the audio and the production is a little bit better, and it's probably a little bit faster for me to make as well. Let's just jump straight in. Manufacturing PMI, as you can see here, sliding again on weak demand and falling outputs. But if we looked a little bit closer, production and employment fell and inventory reductions brought the bulk of the drop. Overall, the read was lower than expected, which on one hand is bad but not terrible, but it is good for inflation cuts that we want to see. Overall, I'm not too interested in the manufacturing. We do know that it's not a strong point in the US economy. What's more concerning is we're seeing weakness in the services sector, which I don't think any of that was out today. Sorry, on Monday. Let's take a look. What else there was? Construction spending. That I didn't like. That fed into my theory a little bit about the housing market being in a stalemate. We won't see contributing factors to falling inflation until after rates are cut from the housing market, which is a big deal because that does make up a big part of the data. But today there was also some really bad jobs market data, so that made me feel a lot more confident that cuts will come soon. Still not likely in July, so that's only 27 days away, I think, when I last checked. It could be less now. But definitely looking good for the month after. Although I have been saying we should get cuts for a while now, so my time frames aren't great, probably a bit like Elon's. Okay, what else? Tuesday, Redbook did show some weakness in the retailer. Nothing crazy, but definitely some cracks there. And there was a speech from JP. I did miss it, although I caught some of the highlights on X, and pretty much business as usual as far as I can tell. He did say that the recent data was looking good, which is promising. So as long as we see a continuation on that, I think, again, July is not looking good, but the month after is probably where it's happening. That is also where the market is pricing it in, which we are also seeing. If we take a look here, I did put the CME watch data on here somewhere. Here we go. Yes, pretty much the market's expecting things to stay the same at the next meeting, which is good because it means the market won't crap itself when it just stays as is. The chances of a cut for the meeting after 71.8%, which is pretty high. I expect to see that to climb through the week if data continues the way it is as well. Okay, so if we go back to jobs data on the Tuesday, they came in higher, not ideal, but as you'll see later on in this video, that's not too much of a concern. Wednesday, we did have a lot of data, so I'll just have a quick look through. Housing still being ignored, so we can probably skip all of this at the top. We get a lot of housing data at the minute, but no one's really looking at it. Jobs cuts decreasing again, but makes sense. The numbers were much higher during the last earnings cycle when we saw a lot of announcements. Probably a lot of that is cycled through now. Initial job loss claims came in a little higher, but mostly there's not much wiggle room on here. I do like the ADP better than the other numbers though. Balance of trade still in a deficit, but as I mentioned on my website, it's normally around about this area. Somewhere closer to 50 billion would be better though. But it's been in a deficit since 1976, so measuring the market by this going into bullish territory, into expansion territory, is probably not a smart thing to do. The one thing I didn't like on this was if I can put it up, this is back in contraction again for the services sector. This is the sector that I don't want to see in contraction, unlike manufacturing. So we'll keep a close eye on that. It could be that it does reverse. I was quite excited in May, but it looks like that could have been a potential red herring there to throw us off a little bit. Business activity was much lower than forecast as well. If we go back to the main chart. Sorry, I'm trying to speak a lot quicker to try and get more content out a lot faster. But hopefully I'm not missing anything. Definitely being blind. How did I miss that? Shocking, Jodie. Again, we see a very similar pattern here. I want to keep an eye on this too. But overall, the data, it does show a lot more cracks coming in the economy. It's not terrible right now, but there is for sure weakness coming in. We're seeing weaker retail, weaker GDP growth, employment for the most part seems like it's okay, but the data today says otherwise. The only thing that's really doing well is big tech companies with a lot of cash because they're able to capitalize on high rates and also really, really start stealing market share from the little boys that are struggling. Thursday, the markets were closed, which brings us to Friday. On the face of it, it seems like a lot less data, but it's more exciting data. Mainly because the non-farm payrolls, everyone was a bit like, oh my God, they're so good, what are we going to do? But actually taking a peek under the hood, ignoring the fact that these government payrolls seem to make up a big chunk of the boost we actually saw in the number here. The May jobs was revised down from 272 to 218, which is not ideal, terrible in fact. And the prior month also was revised down from 165k to 108k. That's also terrible. So I don't know what the market's thinking that they believe these numbers, because I'm expecting a huge revision again next month for this as well. Again, if we look through the numbers more, the unemployment data, this just doesn't correlate with what the headline numbers are telling us, really. There's huge rises, 1 million to 1.5 million year over year in long-term unemployment. And actually seeing the unemployment rate go up again is not great. That's now over the Fed's target. Big picture for today, this data sucks. So it's good for potential rate cuts. The Fed will like the honest data here, but the headline probably going to cause some panic. Sorry, that sounded like I said a rude word there. do apologize. Okay, if we just, there was some other things I wanted to touch on. Oh, the containerized freight still moving up. It had another big move. I think last week it was about 3,000. So this sucks. This is going to put pressure on inflation again. The dollar, right? I did like this. Last week I did mention that it needed to bounce off this point in order for us to see some movement in the small caps and such. I'd be even happier if it broke below this bull market band. Any movement towards the blue line would be spot on for me. Now back to things that concern me. Oil, it did break out of this line. I did mention last week that it had a lot of confluence in regards to resistance in this area. So hopefully that's enough to prevent a pop. For now, it's holding on this fib line, which I like, but I really want to see it back inside this trend zone and have this classed as a false breakout. We all know oil, it's going to drive everything up for inflation. It's probably the worst thing to see a spike in, really. Commodities, again, I'm not too interested in gold or silver. It's lithium that I track this for. It is down month over month, so I do like that. That's good for my Tesla stock, and their energy sector is on fire at the moment. Agriculture, spicy for coffee and chocolate still. Trend is a little bit more to the upside than I would like. I'd like to see this continue back down, but it is what it is, I guess. Not good for inflation either. Although it was nice to see energy get slapped down again for the most part. So year over year, the cost is down greatly. Truflation, this I love. This is now under 2%. I do prefer this as more of a, not necessarily leading indicator, certainly guiding. I find it a lot more of an honest representation of where things currently are than the government numbers. Given the inflation, given the price rises we're seeing there, I wouldn't be surprised to see this start to tick up a little bit. Fear and greed. Markets are neutral. Can't hate that when we're pretty close to all-time highs still. Obviously, crypto's crap the bed today. Keep a close eye on that, but I have been buying the dip, and it still is in fear. It's crazy that we're so far into the cycle run. We normally have a movement now. I'm probably going to have to relook at my exit strategy for crypto, because I think the time frame is going to be pushed quite a bit further back than normal. So I'll need to think of a new strategy for that. Other news and data. Oh, got a bugged out picture there. I can't remember what it was supposed to be. Let me see on the other page. Oh, it's bugged out on all of my pages. I'll have to go back to the website and check that one out then, but I think it was to do with just showing that tech stocks are stealing the show, judging by what I've put in this one, this picture. Basically just showing, don't be chasing the big tech stocks. There's plenty of opportunity down here at the cheaper end of the market. For example, my portfolio is really starting to try and capture some of this. I've been scaling into financials with the small fintechs for a while, and the hated fintechs, PayPal, SoFi, and such. Real estate, I'm starting to nibble on. Looking at Zillow as an interesting buy, actually. Might fancy a bit of that. I'm just doing my research on that now, though. What else was there? Obviously, the energy sector, I've got my solar stuff, and kind of would put Tesla in there as well with the energy storage. But I'm not buying any insanely overpriced mega caps at the minute. I mean, I wouldn't really class them as overpriced. I would just say there's not as much upside potential. They're already at the top, really. Maybe the other picture was about the money market as well. I was saying that there's plenty of cash still to rotate in. Oh, actually, I think it was about small caps. That there's a lot more opportunity there. Yeah, pretty much what I thought I'd put. Sorry, it's really thrown me off a little bit that that picture's not working, because it probably was quite a good talking point, but never mind. I probably won't re-record this, so something to improve on next time, I guess. Just basically I'm showing more things showing that small caps are probably where the move's going to be when rates start coming down, which I think quite a lot of people have been talking about lately. I've been talking about it for 7 months. My timeline, terrible, but as long as I'm right in the end, don't really care. Just something else more showing the unemployment data getting a bit of an issue. Okay, I think that's it. Give me a like, give me a share, do all that jazz. Hopefully you enjoyed it.